market master for the day, Gautam Chowcharya, Head of India Research at UBS Securities. Hi Gautam, good morning. Thank you very much for joining us on what could ultimately turn out to be a very historic day. You called 8,000 some time back, didn't you? When did you?
Early in the year, yeah, but it's already reaching there. That's the December 14 target.
All right, but what is the sense? Do you think now by the end of the year we could do much better than 8,000? Or what is your fresh, say, 12-month target or your March 31st target?
So we don't have a formal next year's target yet, but we have been writing that even the 8,000 target market always has potential to overshoot. So it could overshoot surely. And again, slightly thinking medium term, still looking at, we were fairly comfortable with the view of 15-16% earnings growth for the next 2 years. Despite our base case view of a milder growth recovery versus what the street is looking at. So a 15% growth rate should be supportive of markets delivering that kind of returns anyway.
Okay. Gautam, hi, good morning. We'll come back to the equity markets in a bit, but I was reading your latest report this morning that where you argue that the RBI could keep the policy rates on hold till late FY15. What is that argument predicated on?
Yeah. So we have been big believers in inflation coming down because we don't believe inflation in India, including food inflation, is structural. So all the arguments behind that we are not convinced because all the arguments are supporting that held true even before 5 years back. So we have been believers in that. We are fairly confident of the 6% CPI Jan 16 target of RBI. But having said that, while bond markets and markets will react in anticipation of inflation coming down, RBI would actually like to still keep the monetary environment reasonable, and policy cycle will lag inflation moderation because they want positive real rates to revive financial savings as well as to kill entrenched inflation expectations.
Okay, so what is the yield trajectory, say a year, 12 months down the line? Does it go below 7%, the 10-year yield?
So we are looking at a 10-year yield touching 6.5% by end of FY16, which is almost 200 basis points decline from current levels and broadly following the CPI trajectory.
6.5 is 200 basis points lower from today's levels of 8.5. So maybe 12 months down the line, we are definitely sub 8.
Yeah.
What does that do to equity investments?
So two ways to look at it. The theoretical argument is that this means lower risk-free rate of capital, and therefore the equity markets valuations multiples should go up. But if you look at India's own history or even other global markets experience, it's not necessarily coincident. It ultimately would, but in the near term it may not hold true because lower bond yields in the short term is also reflective of growth not being as exciting. So and therefore we want to also highlight, bringing our point that our growth recovery hopes are much milder than what the street is looking at.
The 8,000 target that you have by the end of the year, Gautam, what are the stocks that could actually lead it there? Because in this month gone by, we've seen fresh leadership emerge from sectors like pharma, technology, autos, etc.
So we continue to be more biased towards cyclicals, and by cyclicals we mean the financials primarily, and also the oil SOE space. So these two will be the big drivers in our view. In a bull market environment in which we are right now for India, literally all the sectors tend to participate. So what we saw over the last couple of months will keep on happening, that you will see sectors which are not necessarily the cyclical sectors will keep on catching up as market moves up. So while those sectors will also do well on a relative basis, we still prefer the cyclicals and primarily financials. Apart from that, the SOE oil companies.
Okay, so what would be the best banking bets? People normally prefer the private sector banks. What are your picks over there, and what are your picks in the public sector banking space?
So private banks we continue to like as a pack. That ranges from HDFC Bank to ICICI to Axis, and even the smaller banks. We still remain quite bullish on the SOE banks, and the top picks for us there is SBI and PNB, and this is despite the recent concerns, etc. And we also, in fact, like the entire NBFC space, Shriram Transport and LIC Housing.
Okay.
Actually, there is
In fact, we do have a query that's posted on our Money Control message board. I think this is with respect to the NBFCs itself, so let me toss that to you. Sharda has written to us from New Delhi and she wants to know which stocks from the NBFC space could be a long-term retail investor or rather an investor like her could buy. You said Shriram and LIC Housing. Can you just elaborate and is it just these two or are there other options as well?
So broadly, the entire, again, there are the two ways to look at it. One is this NBFC is benefiting from this rate moderation thesis. So in this, the entire NBFC space benefits from a Shriram to asset financing companies to a Cholamandalam Finance and to mortgage finance companies like LIC Housing. But on a more longer term basis, obviously the mortgage is a much more secular, longer term, less cyclical story. So in that sense, LIC Housing could be the top pick there.
So would that also mean that you have a stronger buy in something like a Yes Bank, or for that matter, even in the NBFC space, HDFC?
Yeah, so all these companies which are aligned on wholesale financing will benefit clearly.
Okay. What else in the mid-cap space? I know you track that space very closely, Gautam, and you've been giving us a lot of ideas that have worked extremely well in the last 5 to 6 odd months, so say in the year up until now. Any fresh ideas that you've drawn up that one can buy in the mid-cap space?
So frankly, it's becoming tougher now. But the stock we continue to like and where we still see significant upside from current levels in terms of both earnings and multiples is MCX. So that's a name where we still remain bullish.
Fair point. Actually, you were
apart from MCX, the names which we are pushing right now in terms of mid caps is Britannia and Crompton Greaves.
Oh, I was just coming to Crompton Greaves. Actually, you were the earliest to spot stocks like Crompton Greaves, Voltas, and Carborundum Universal. Are these also still in your buy list? You spoke about Crompton, but the others?
They're still in a buy list, but obviously the risk reward in terms of valuations is not as great as they used to be. But the interesting point is say for a company like Voltas, despite earnings increases, they still beat those higher earnings estimates. So there still remains earnings momentum. So these stocks will still do well from here. We still have a buy. They're no longer significant upside stories as they used to be 6 months back.
One of the big gainers this month has been Havels, Gautam, up almost 20%. Is this a story that you like and would you recommend it at these 280 levels?
So it's a great business, it's a great company. We continue to like the business and the company, but at these levels, we are not comfortable recommending a buy for the stock, given the valuations.
Okay, let's come to this news that shook us all. Earlier this week, the Supreme Court ordering that, or at least giving a verdict that all coal blocks allocated since 1993 are illegal. How do you see that play out? Does this make you wary of power stocks or any of the metal stocks?
Again, this is a slightly legal issue, but whatever sense we get talking to legal experts as well as ex-bureaucrats in the coal ministry, and the interpretations coming out of the Supreme Court ruling, it doesn't look like a scenario of a wholesale deallocation of coal blocks like the ones we saw in telecom.
Yeah.
And secondly, they haven't really come down and stopped mining activity per se. So, and third is obviously it does lay down the path for a more transparent, clearer policy environment which can help attract bigger and quicker investment from the private sector. So in the long term, this sounds could be a good one, but in the short term, obviously that does create issues, but more maybe for specific companies. The bigger thing is what happens in the next few weeks, and even more so how the government reacts. If government comes up with a plan which kind of tackles the uncertainty in the next couple of quarters head on, then I don't think this is a big deal as far as the macro is concerned or as far as the power sector is concerned. But specific individual companies could get hurt, which is what the stock prices are reflecting.
Okay. You said earlier that you expect the 10-year yield to go to 6.5% by the end of FY16. And I read in your note that this may precede a policy rate cuts of a similar magnitude. What are the kind of rate cuts that you're expecting by the end of FY16? And how will the US move on, higher rates dampen the entire situation?
Sure. So the policy rate forecast which we have is still 75 basis points by FY16 end. And the 10-year yield coming off 20 basis points also reflects the significant decline in inflation risk premia. The other part to remember is still very unclear on how the RBI looks at the inflation environment and the growth environment, and whether it's willing to look at the short-term liquidity environment to move from current deficit to a surplus. If it gets comfortable towards a surplus liquidity environment where it loosens up or supports liquidity, in that case it anyway effectively becomes another 100 basis point rate cut, because the policy rate moves from repo to reverse repo. And our analysis shows that something similar happened early last decade also. And the 10-year and the short-term rates, etc., instead of reflecting the repo rate, started reflecting the reverse repo rate. So that's the second thing to remember, but that's still unclear. The US rate part, we are less worried. It's an obvious worry in the short term, and markets could be volatile around that in the short term. But if you look at India's bond yield spread versus US rates or versus emerging market bond rates, both on nominal and real terms, it's actually near higher end of the range versus history. And even if you assume our US rate forecast is 4%, which is much more aggressive than the forward implied 3.2% odd by FY16 end, even if you assume that, the spreads will be in line with what we have seen historically. So 6.5% move, if it's reflecting the inflation moderation, it can be very, very easily justified.
Okay. Within the oil space, you said that that's one of your favorite sectors. What's the pecking order, stock-wise?
So top pick is actually ONGC. So we prefer that in this entire subsidy coming off thesis. And then we also like Reliance Industries. So these two are our top picks there.
Who would be your underperformers in the Nifty in the next 12 months? Not giving targets, even an underperformer could rise. But who would the underperformers be? Specifically, I wanted your comment on Larsen. It saw enough creaming off of gains anyways. But if your growth outlook is tepid, then is Larsen an underperformer?
So, apologies, but I can't comment on Larsen because it's not under coverage as of not temporarily because of analyst turnover. But yeah, broadly speaking, the underperforming sector in our view will be more the consumption side. Because again goes back to the thesis of gradual growth recovery, not a sharp uptick in recovery. And we're talking about an environment of fiscal consolidation and damping of inflation, which in the short term is never good for consumer activity. So in our view, at least top down, the recent hopes for a sharp uptick in consumer activity, I think that seems misplaced in our view.
Okay. You briefly mentioned your view on MCX, but I just wanted you to elaborate on that, Gautam, because you're one of the few people who track it so closely. What did you make of, the latest news flow is that Financial Technologies has sold its stake in MCX, but the stock has seen such a good run up in the last 3-4 months. What would your, say, 6 or 12-month target be on MCX?
So the thing is, even after the run-up, and the run-up were from quite very, very low levels, at current price, the valuations are still at a discount to regional stock exchanges, despite having arguably better growth outlook. Secondly, with the change in ownership, the volume should go up because a lot of the volumes had been impacted because of credibility issues, etc. And the third bigger delta is obviously the entire FCRA bill possibility. So if and when that happens, that can provide a significant leg up in terms of trading volumes by introduction of option contracts or by allowing more banking sector intermediaries. So that can provide significant upside to the secular growth in numbers which we are building in. So from a risk-reward perspective, there seems limited downside from current levels, while the upside can be significant. So I think our target price is around 1,050 levels, but the upside depends a lot on the FCRA bill.
Fair point. Gautam Tachara, it was a pleasure speaking with you. You have thrown a lot of ideas for us to think about, and of course a lot of stock ideas as well.